in the early 2000s, this book came out by Maggie Maher, and actually uh, Buffett had recommended this book. It's a great book to read, and basically Maggie pointed out that even though we have these, like if you look at the S&P over a 100-year period, 9% a year, uh, that's not the full truth, if you will. And there's more to that than just that 9%. And so this is a chart of the Dow from 1896 till now. So it's covering about 124 years. And you can see that there have been very long periods where end to end the result has been zero for investors. Like for example, a famous one is after the crash of 29, it took a good quarter century to get back to the same levels. And more recently, if you look at the period from 65 to 82, the Dow was like, I think, 870 or 865 or so at that time in 65, and that's approximately where it ended in 81, 82. So 17-year period when the US economy grew quite a bit, but the Dow was flat. And then 82 to 99, which is also probably before the time of most of the people attending, the Dow was turbocharged. It went from less than 1,000 to more than 12,000. And then more recently, from 99 to 2011 was flat. And then since 2011, we've been on the rise. So, and then, if I just, I'll show you a few more charts like this, but this particular one has some symmetry. So the symmetry is that we had a 17-year period, 65 to 82, where the Dow was flat, and we had another exact 17-year period when the Dow, did incredible things. And the reason we get these periods, and especially I think 17 years is an important number. In general, human memory does not go past 17 years. And the reason we see these kind of long periods of flat markets and then, similar periods of, very euphoric rises in prices, if you will, or just rises in prices, is usually, like, for example, in 1965, stocks were quite overheated. Very high PE ratios, high multiples. And in 81, 82, they were extremely undervalued. And one could argue whether it's undervalued because at that time in 81 or so, treasuries were yielding 18%. And so in the 81, 82 timeframe, you could have bought a lot of blue chips at single digit multiples, Coke and McDonald's and, all kinds of great businesses were available very, very cheap. And then when you got to 99, 2000, those same businesses were priced for perfection. So for example, in the year 2000, Microsoft became, for some time, the most valued company on the planet. Cisco was right up there. Both these companies were about 600 billion or so in value. And Microsoft, I think, was making less than 10 billion. And such. So it was at I think it was at a 70 plus trailing earnings multiple. And so these charts are very relevant to me because I always have great timing in life, and I started my fund in 1999, and what a beautiful time to start a fund. Um, I actually knew pretty soon after I started that I was I was going to be. I assumed at that time that there was poetry and symmetry, and history did not just rhyme, but history repeats itself. So I just assumed that till 2016, we were going to be flat. I assumed we were going to be flat on the Dow till 2016, and I assumed we were going to be flat on the Dow, on the S&P till 2016 or so. And the Nasdaq, I didn't even know when that would come back, because that had crashed and burned from 5,000 down to 1,000. So I thought that was just done for a very long time. And so I started my journey as an investor in '94. That was the first time I heard about Warren Buffett, and it opened up a whole big world for me. And 1994 was one of the one of the years of maximized learning and growth for me. I was it was a completely new area for me, and I was just like a sponge. I was just drinking from a fire hydrant, and it was great. And at that time, life was really good, because pretty much anything you did went up. Things. And I was running an IT business. I was kind of around the software business and so on, and so I had some of the investments were tech investments at that time, and in that period, and I was only running my personal money at that time. There was no fund, and in that period, I captured two more than 100 baggers. Unfortunately, there wasn't much of a net worth. And so, for example, one business business in India, I'd put about $10,000 or $12,000, and I cashed out about 1.5 million. And of course, I should not, have any regrets about that. That's pretty good. And then there was another business here in the U.S. So the India business was Satyam Computers, and the one in the U.S., which was a way to kind of ride the internet wave and so on, upside to the downside. A company called CMGI, actually, I actually visited them in Massachusetts around that period. And that was about 100 bagger, which I captured. And there I actually put in more money. I put in about 100,000. And so the results were pretty good there, about 10 million. So, but then when I was starting the funds in 99 and 2000 and so on, I knew I was going to be facing these huge headwinds. And I knew that that pretty much anything you looked at didn't look. I think all the popular stuff was euphoric, but actually, the day the Nasdaq peaked in March 2000, March 9th or something, 2000, was the day that Berkshire hit a multi-year low. So basically, what was happening is that money was going from Berkshire Hathaway into Pets.com. There was that transfer going on. So a lot of stuff actually, which was very basic stuff, was undervalued in 99, 2000. But if you were trying to play any kind of momentum game or, flavor of the day or any of that stuff, you very quickly got your head handed to you. Because then the Nasdaq went from like 5,000 to 1,000 next couple of years, 2-3 years. So I knew that the modus operandi I took on when I started my fund was, I really didn't care about the market much. I knew the market was going to give me a headwind, but I said, how does it matter what these market levels and all that are, or whether it's euphoric or not, if all I do is I focus on buying $1 for 50 cents And when that dollar gets to 90 cents or more, I sell it. And so that became the cornerstone of how I invested. Is I looked for dollar bills that were trading for 50 cents or less, and then as they got to 90 cents or more, I was unloading them, which was different from the previous 5 years, where, like, for example, the company I bought in India, um, I just took those shares, and I actually got physical shares, stuck them in a drawer, and my mental model was to never open that drawer. I wasn't even concerned with what the multiple was. I knew that they had so much tailwinds in terms of growth that I didn't want to really mess with any calculations. I just said, set it and forget it kind of thing. And the same thing with CMGI. I could not tell kind of what the upper limits of CMGI were. It was kind of very nebulous. But I was buying at a pretty floor price because CMGI was spawning .coms. So, how many .coms they're going to spawn, I have no idea. What valuations are those going to have? No idea. But it all looks like wild and crazy. So we'll just keep the mothership that keeps producing these eggs and see where it goes. And eventually it got to a ridiculous valuation. Thankfully, I was smart enough to sell and move on. But in the last 20 years or 21 years, I took this buy at 50 or less and sell at 90 or more, and that actually works quite well in this environment from 1999 to 2011. So what I'm trying to say is that if I look at my 25-year or 26-year journey, I was using two different models for two different periods. Okay, and one of the things I forgot, because it had been so long that I'd been doing the buying at 50 and selling at 90, that it completely left my mind that I'm supposed to at some point switch back. Okay, and I never really, I just thought this buy at 50, sell at 90 is kind of the way I go through permanently. And let me just go through some of these slides, and then I'll continue with kind of, because the year 2020, most humans want to go from the year 2019 straight to 2021. They want to purge 2020, that they want to behave like 2020 never happened. That's how they would like to go through life. In my case, 2020, I would say, has been probably the second highest year of learning after 94. And so I've had incredible learning and growth this year. I'm very grateful for the learning and growth. Who knows if the pandemic had anything to do with it? Maybe it did, because I got so much time to stare at my navel. And when I contemplate my navel, good things happen. So I had a lot of contemplation of the navel this year. And anyway, so this is the Dow, and you look at the S&P, and it's somewhat similar. It didn't have the exact 17, but recently till 2013 it was completely flat. And then you look at the Nasdaq, and what a beautiful chart. So you look at the Nasdaq, and from 1980 to 2000, 20% a year. Awesome, great. And then, of course, you can see the head handed to you from 2000 till 2003 or something, when it gets close to 1,000, and then it takes 16 years to get back to the 5,000 level, and then more recently it's been doing the 21% or so. So the Nasdaq is kind of interesting because it's actually gone through this, and actually, if you think about the Nasdaq, yes, from 1980 to 2000, there was incredible technological innovations in tech and software and hardware and so on. But so was the case from 2000 to 2016. I mean, even till now. I mean, there's been incredible changes. But what happened is that the valuations in 2000 was so high that all the growth and growth and profits and all of that were not enough to get the index back to where it was. So, for example, a good example is Microsoft. I remember in 2000, I just started the fund. There was a guy who was one of the early employees at Microsoft, pretty high up, and he had retired. And he said, he joined my fund. He said, Mohnish, if you're ever in Seattle, I could introduce you to some of my former colleagues and some people who've left, and they may have an interest in your fund and so on. So I told him, hey, I'm going to be in Seattle day after tomorrow. What a coincidence. And so he said, oh, that's great. So we spent a day where he took me to Microsoft headquarters, and I went from one office to the other, and he was he was a great sales guy for me, trying to convince these guys to give me money. And I got a lot of commitments and a lot of investors from Microsoft or former Microsoft people, some current, some former. It was great. But I told them all at that time when we were just talking that I said, look, you guys have, in many cases, 90% of your net worth in Microsoft stock and options, and your livelihood comes from the same place. And I said, I hate to burst your bubble, but this is not going to end well. And they all told me, oh, you don't understand our business. The company's never, the stock just goes up like clockwork, and we get our options and we hang on to them, and life is great. And I told them that was not going to be the case. But none of them actually even wanted to hear the math about the 70 times trailing earnings or whatever else. And until 2015 or 16, Microsoft was zero returns. And it wasn't just zero returns. It was a very violent ride with a huge drop in the next 2 or 3 years, and then another huge drop during the financial crisis. It would have been very, very hard to hold the stock over that period. And of course, finally, they've kind of digested that, and now we're back on the upswing. And then we get to the Nikkei, which peaked in 1990 and has not yet come back. And so it's been 30 or 31 years of minus 2% a year. So the more fun the party, the more extreme the hangover. And this was a very fun party. This was a party like no other. So at that time, I think in 1990, and this was anecdotal evidence, I looked it up. They said the Imperial Palace in Tokyo was valued more than all the real estate, the entire state of California in terms of real estate. And I actually found that statistic pretty hard to believe, so I actually researched it. And it was absolutely true, actually. If you looked at the transaction prices of the properties right around the Imperial Palace, and then you extrapolate it to the square footage and acreage of the Imperial Palace, you would get to a valuation that would exceed state of California. And of course, that's a ridiculous valuation. We have beautiful coastline for thousands of miles here in California, and there's some very, 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 very valuable real estate. And so that bubble popped, and we haven't come back yet. And we'll have to see when we come back. And then you look at the Korean Kospi, and this is another one where if you ignore that 2009 to 2011 period, it's pretty similar to Japan. It's basically been about 30 plus years of pretty much nothing, and especially the last few years. And Korea, if you look at Korea, in '89, I mean, the Korean economy as we know it doesn't exist at that time. I mean, it's an incredible miracle growth economy. I mean, Japan was already an advanced civilization. Korea was yet to have its run, and in spite of all that run, the Kospi hasn't moved. And actually, Korea is quite a cheap market. It's a place I'm actually interested and excited to invest in.